Welcome to the Live Big podcast, where real estate expert Nick Paynes shows you that everyone can build wealth through real estate investing. Nick and his featured guests will give you the tools, resources, and expert information you need to leverage real estate into a wealth-building strategy, so you can stop worrying about your 9-to-5 and start to live big. Here's Nick with today's episode.
Welcome back, everybody, to the Live Big podcast. We are on episode number 20. I hope everyone's out there living their dream. We are today going to talk about a concept that might be new to many of you. Some of you may have heard something about it before. And anyway, we'll get kind of right into it. So today we're going to talk about real estate syndication. So this is probably going to end up being a multi-part podcast. We'll just kind of get into the basics on today's show, but there's really a lot to uncover with real estate syndication. So we'll kind of start with the basics, and then maybe we'll get into the weeds a little bit more on some future episodes. I know at least we're going to do a two-parter this week and next week with some of the overreaching basics of real estate syndication. But let's kind of get started with some of the few basic questions. So first of all, what is real estate syndication? So syndication is essentially, the best way to describe it, I think, is to think of it as like crowdfunding for real estate. So it's when you're looking to buy a building, generally a piece of commercial property. It could be a big multifamily apartment building. It could be really anything, any type of big commercial real estate or really expensive real estate, where the idea is that an individual probably doesn't have the liquidity or even just the overall financial ability to purchase a big piece of real estate like that. So what we do is we create a real estate syndication. It's essentially a partnership between a bunch of parties that will own the property in an LLC. Okay, and so the reason that you would go into a real estate syndication would be if you had some investable assets, but maybe you wanted to diversify and get into real estate, but you really didn't want to be a landlord. You really didn't want to worry about having to manage the property or even find the property. Maybe your day job just gives you way too much to think about, way too much stress, and you just want to invest your assets or invest your money somewhere in the real estate realm. And so with real estate syndication, it allows you to kind of just put your money in to the syndication piece and let what we call the general partners, and we'll talk a little bit more about that here in a minute. We'll let the general partners kind of take over control of running the asset management, and keeping the property in line and creating profitability. And so when you look at a syndication, we break it into two sides. And so the first side is the general partners or the GP side of the syndication. And then the secondary side is the limited partner or the LP side of the syndication. The limited partner is people who are using their money, who are investing financially. And the general partners are generally people who are investing time and effort, and may also be investing money into the deal as well. Okay, so again, we're going to talk about two of those individual pieces here next. So let's talk first kind of about the moving parts of the syndication. So obviously, like we said, we've got the two sides, the general partner side and the limited partner side. Think of the limited partner side as the money. Who's bringing the money into the deal? And the general partners are going to be kind of broken down into a handful of categories. One of them, for example, is going to be the deal sourcer. So somebody is going to source the deal. Somebody's going to find the deal, whether it be off market, on market, doesn't really matter, but they're going to find a deal that makes sense. The second person, and obviously these people can carry multiple roles, or multiple people on the GP side could be in charge of multiple roles as well. But the second piece is going to be kind of the underwriting process of the property. So when they go through the underwriting process, it's a handful of spreadsheets that we're putting numbers into to make sure that the property makes sense as an investment. So what's the net operating income going to be? What are the expenses? What are the rent rolls? all the different things that we look at, and we run those through a series of calculations to make sure that the property is going to make sense as an investment. So usually we're going to have multiple people working on that underwriting side, making sure that the numbers make sense, not only on the general partner side, but as you get deeper into the transaction, your general partners aren't going to be the only ones that are underwriting the deal. The lenders are going to underwrite the deal. A lot of times the attorneys that are involved, maybe the SEC attorney that's involved, those people might underwrite the deal as well. And so it's going to be a lot of eyes on the deal. Okay. The third piece of the general partner side is generally going to be somebody who's in charge of what we call asset management. Okay. And so this is really going to be the person that's kind of the boots on the ground, somebody who's going into the property, maybe walking the property, making sure that, our renovation budget is in line, working with the general contractors, working with the property management company, that type of stuff. So asset manager is really your boots on the ground type of person. And then your fourth person that's going to be involved is somebody who is a capital raiser, somebody who has the connections with people that have money that they can bring to the deal and want to be involved. Okay. So again, that is the general partner side of the syndication business. The general partners, again, are the ones that source the deal, source the funds, underwrite the project, manage the asset, work with the attorneys, work with the lenders. Those are the people that are going to be kind of involved in the deal. The limited partners, again, they're really just bringing money. Okay. So those are kind of the I suppose the moving parts of the syndication. Okay. So again, each of these jobs can kind of be shared by another individual that's on the general partner side. It's not just like individually one person doing each job. They're all kind of sharing in those responsibilities. But generally speaking, you're going to have somebody that kind of specializes in one side. You might have somebody that has a lot of great capital connections, so they'll probably focus on raising capital. You have another person that's just really good in the spreadsheets, really good at understanding the numbers. They're going to focus a little bit more on the underwriting side. Okay. So the limited partner side is strictly funding. Okay. They're silent partners in the deal. So they generally have no say in what happens with the project. They don't get to decide like, okay, how much money, or I'm sorry, like what are we doing with the property? What type of renovations are taking place? They don't get to decide any of that. Okay. That's all in the general partner side. The limited partner side is strictly money. Okay. So you put your money in, you get a percentage of ownership of that property. Okay. It's not a loan. It's percentage of ownership. It's equity. Okay. So you get an equity share in the property. Okay. So this is different than being, for example, a hard money lender, where generally your money is secured by a deed of trust or a promissory note or something like that, leveraged against a piece of property, or maybe one of the people who you're loaning to, against one of their personal assets, and it's personally guaranteed. Or it can be personally guaranteed. In this case, with a limited partner, you are a part owner in the asset. Okay, so you get to take advantage of I should say you get the advantages and the disadvantages of owning property. So if you lose money in the deal, you will lose money. Lenders don't lose money in the deal generally. They're either going to make their money back or they're going to foreclose on the property. In the syndication part of the deal, the limited partners actually own equity in the property. Okay. So they take the risk of any money lost, but they also get the advantage of the upside, which can, as we've talked about before, can be really extreme in real estate. Okay. So they're going to fund the deal. They don't have a deed of trust. They just have a part ownership in the partnership that's going to kind of own the project. Okay. So, some of the other things that we need in this process. Syndications are going to involve like a full team of people, okay? Because we're not just buying like a single family residence here where we have just like an inspector and an appraiser and a lender and a real estate broker go in. Okay, the syndication is going to involve a huge team of people. Okay, and so we're looking at we're going to have a team of attorneys. We're generally going to have a real estate attorney that's going to review the contracts, and we're not always necessarily using real estate brokers in these syndication deals. We're self-representing. Pardon me. We're self-representing, and we're using attorneys to review our contracts. Okay, so. You're generally going to need an SEC attorney to set up the syndication. So part of real estate syndication is that you're dealing in securities, right? So you're dealing with something where somebody owns an asset or owns an equity or security where the value changes, and we have to protect people's money. So as syndicators, one of our number one priorities is to protect the money that is invested in our project. So what the SEC attorney does is anytime you're dealing in securities, is you are going to generally deal with the Securities and Exchange Commission or the SEC. So obviously the SEC and the things like the stock market and companies that are publicly traded are highly regulated by the SEC. So there's lots of rules, there's lots of red tape. And so when you're going into a syndication deal, you're going to run that syndication through an SEC attorney and generally get some sort of exemption. Okay, so this exemption that we're looking at is is so that we don't have to follow some of those standard regulations that the SEC puts on securities, securities exchanges and things like that. So what we're doing is we're going through an exemption, and we may have another podcast where we talk a little bit more about this, and maybe get an SEC attorney on with us to talk a little bit more about it. But we have what we call 501. We have most syndications run through like a 501c or a 501b exemption, which is a portion of the code that allows you to, as long as you limit your capital raise to certain types of people, then you don't have the same regulatory, rules or laws that you would have with some other securities. So anyway, generally we raise money through either what's called a 501c or a 501b. And really the difference between those two things is who is allowed to provide you with money and how many people are allowed to do that. So generally speaking, there are, when you're raising money, a lot of times we have to stay with people who are accredited investors. Accredited investors are defined by the amount of money they make and their net worth, okay, and also their knowledge behind investing. Okay, so we'll get into that a little bit more on kind of a different episode. But SEC attorney for sure is needed in a syndication. You also will need a real estate attorney to review your contracts, make sure that any changes that you need throughout the contractual period are go through that real estate attorney. Because in these types of transactions, we have a lot of money on the line. So on a decent sized deal, you might, if you're buying a $20 million building, for example, you might have $250,000 of earnest money on the line, right? So it is a really big deal to make sure that you're following your contractual processes like to a T to make sure that you don't put your earnest money at risk. Okay. This is not just like a couple $1,000s in earnest money that you might have on a residential deal. There's hundreds of thousands of dollars involved, and you want to make sure that you have the ability to get that money back in the event that something goes astray. Okay. You're gonna need to have a great insurance company or great insurance connection that you're working with. Okay, so we're talking about a huge asset worth millions and millions of dollars. We want to make sure that we have a proper insurance policy on it. And again, it's not as simple as just like calling the insurance company and going, "Hey, how much can you insure this for?" Right? There's a little bit more of a process there. You're going to need a lender, a commercial lender. Okay. Most of the lending that happens on these properties, we can either go with portfolio product that's just kind of like an in-house product for the particular bank. But a lot of these big deals are actually backed by Fannie Mae and Freddie Mac. So these are government loans that are actually fairly favorable to the investor. They have great interest-only loans where you're paying interest only for the first couple of years. They have great adjustable rate mortgages that don't adjust for many years. So there's great product because the government wants to incentivize people to maintain and renovate and grow housing. Obviously, throughout the United States, we have a major housing shortage. And so people who are willing to put up the money to go in and renovate and improve the existing structures that are there, or even people that are willing to go in and do development projects, the government tries to incentivize those people and creates things like opportunity zones where there's great tax deferment and tax exemption opportunities. So there's all kinds of ways to incentivize investors to do this, which makes it very favorable. Okay, so you're going to have a great commercial lender that's going to work with this. You're also probably going to engage the services of a high-end or a higher-end property manager, right? This isn't just like your friend that likes to, that manages a handful of rental properties, or maybe you're just locally owned deal. This is probably like a nationally organized property management company, because not only are they going to need to manage, let's say it's 200 doors or, whatever it may be in the property that you're buying, this big unit, like 200 doors. But the due diligence process can be very overwhelming when you're going through the contractual period of the purchase. So it is the responsibility of the general partners to go through and evaluate every single door in that property, right? So no different than if you were buying a single family residence, you would go in and inspect that property. You're going to go in and you're going to inspect every single unit in a 200 unit apartment complex. And not only that, but you're going to audit every single file for every single unit. So you're going to audit all the leases. Okay, you're going to audit the rent rolls, because what happens is you get people who currently own the properties that either A, have no idea what's coming in and going out, okay, or B, they lie about it, right? So they say like, okay, we've got 200 units. We only have 20 vacant units. And then you go in and you see that there's 30 vacant units. Okay. That's an audit process that has to be done, because that amount of vacancy significantly affects the value of the property. And we need to figure out why that vacancy is there, right? Or they say, hey, we've got 10 leases at 1,500 and 20 leases at 1,600 and so on and so forth. And you go in and find that they overshot their lease number by $50 per lease times 200 leases. That's significant, right? So we're talking $10,000 a month or $120,000 per year. Okay. So that's another piece that you may employ. You may have one other person too that actually gets involved in the general partnership side, and that's what we call a key principal. So the key principal is really just financial backing for the project, and it's not necessarily that they're putting money into the deal. That's what the LP side is, but there has to be somebody that can qualify for the sizable loan that you're looking for. So again, let's say you're looking for a $20 million apartment building. Okay, generally speaking, you're going to need to put down somewhere between 25 and 30%. So let's call it 30%. That's $6 million. So your LP side is going to be at least a $6 million raise. If you've got renovations and things like that, you're going to have at least a $6 million raise. Plus, you're going to have all the money that it takes to, do the deal. Your lawyer, your attorney fees, your closing fees, your origination fees for lending, all that stuff. So there's a lot of fees that are involved. So your raise is going to be, $6 million for the down payment, but then you're going to have another $1 million to $1.5 million in fees and all that kind of stuff. And then you're going to have your renovation fees on top of that. So you're going to have this pretty large raise. And then the bank is going to maybe give you a loan for $14 million. Banks don't just generally go out and give random people $14 million loans for apartment buildings. They need to be able to show that they have experience in the industry, and that they have the kind of net worth that justifies giving that loan amount. Okay. So as a rule of thumb, generally speaking, the key principal or the general partners as a combined group would need to have a net worth at least the size of the loan amount. Okay. So if you had 5 general partners, let's say you didn't have a key principal, and you're trying to buy a $20 million building, which would require a $14 million loan. Okay. those general partners would have to have a net worth together that exceeds $14 million. Okay. They would also have to have the experience of dealing with or managing a 200 unit or more property. So again, there's a little bit of gray area in this, but generally speaking, what a bank would probably like to see in a situation like this is, first of all, net worth that far exceeds that 14 million, right? So again, let's say you have those 5 people and they got a total of maybe 5 million in net worth. They're going to need to find a key principal that has at least $10 million in net worth to come in and sign on the deal. The second piece is you need somebody with the experience of owning and managing multifamily. So somebody who already has 200 units under their belt, somebody who already has 500 units under their belt. So if you've got 5 general partners that don't have any of the units, they're going to need a key principal for that. So there are opportunities or possibilities that you run into, where you may end up with 2 key principals. You may have somebody that represents the net worth side, and then you may have somebody that represents kind of the ownership of that many properties. Okay. So in this case, you've got these key principals that come in. They may not even be financially involved in the deal at all. They may just be the signer on the note. And there's incredible value to that, because without them, there is no deal. Right. So the key principal may come in and they may not be they're probably going to underwrite the deal, because they're probably not going to put their name on the deal if it doesn't look good, but they'll probably underwrite the deal, but they may not be bringing any money. They may not be helping raise any money. They may be, they may not be doing any of the asset management. They're just using their name as collateral, essentially, to acquire the property. So those key principals generally end up with a big percentage of that general partnership side, because the deal couldn't get done without them. Okay, so there's more. Obviously, there's more to this. There's more to what the key principals can do, what the general partners do. This is just a very kind of high level, or I should say low level, broad kind of overview of what a syndication looks like. Syndication can be done pretty much with any deal. Okay. So it can be apartment buildings. It could be commercial. It could be office space. It could be doctor's offices. It could be mobile home parks. It could be land. Any of these deals can be syndicated, because all it is just a partnership agreement between a bunch of people that want to invest in real estate. So the idea here is you're finding some people that, usually the general partner side is you're finding a bunch of hungry individuals that are willing to go out and try to source deals, work hard, to manage the asset, to renovate the deal. And then on the limited partner side, you've got people that are more, they value time more than money. And so they kind of go, hey, I've got money, but I don't have time to deal with all this. I don't have time to manage my own property. I'd like to maybe just give somebody some money and they can go do the deal for me. Okay. So one of the questions that I tend to get with syndication is like, what do returns look like on syndication, and how do people get paid through a syndication model? So there's many different ways that you can run this, and generally this is something that's determined on the general partner side. So the general partners are going to determine what the returns look like. But I'm going to give you kind of an overall, just a one way that we see it that's fairly common, and just know that it can kind of deviate from one side to the other. But generally speaking, what we're looking at on a general partner to limited partner split is somewhere in like the 70-30 range. So the general partners may take like 30% of the deal, and the limited partners would take 70% of the deal. Okay. So just to kind of put that into perspective, what that looks like is, let's say you had a deal where, let's say we're buying a $4 million apartment building. Okay. That would mean you'd need about $1 million raise. Okay. Now, again, you're going to need more than that for extra fees. And you're going to need more than that for renovation. So let's maybe change it and say it's a $3 million building. It's a $1 million raise. Okay. Part of that's going to down payment. The rest of it's going to renovations and fees. So if you have a $1 million raise, okay, and let's say you're able to do it with 10 people, 10 limited partners, okay, and let's say they make all equal contributions of $100,000 per person. So you've got 10 people that put $100,000 per person in, and let's say the general partnership side didn't put any money in. Okay. What you're going to end up with on a 70-30 split is that the profits, whether it be cash flow or whether it be upon disposition or sale of the asset on the back end, whatever those profits are, they're going to be split 70-30. Okay. So if, let's say, there's $10,000 per month in free cash flow, then that cash flow, 70% of it is going to go to the investors, which is $7,000 per month. And it's going to be divided equally amongst those because they all made equal investments. So amongst the 10 people, $7,000 is divided by 10 is $700 per month. So each of those investors might get a return of $700 per month. And the limited partners would split the $3,000 per month, however they see fit. Again, that and I might have misspoke that the general partner side is going to get $3,000. Okay. Now, depending on how many general partners there are, they're going to have their own partnership agreement as to who gets what. If you've got a capital raiser, for example, that raised the entire amount of capital, they may get a bigger split of that $3,000 than maybe somebody who just underwrote the deal. Okay, so they're going to have their own agreement within the general partner side that says what each of them gets paid. Okay, so when upon disposition of the asset, so once they sell the property, same thing. Whatever the profit is there after all the costs of sale, let's say it's exactly $1 million. Again, that's going to get split 70-30. Okay, so 700,000 of it is going to go to the limited partner side. Again, divided by 10 means $70,000 is going to go to each investor. Okay, and then the general partners will split the 300,000. Okay, so that's kind of the overall like what you may see there, and understand that there are different things that you look at. So when you have a deal that comes through as a general partner, so the process would be you find a deal. Okay. And you attempt to get it under contract. So you work through negotiations, you get it under contract. Once you get a commercial deal like this under contract, you're generally going to have somewhere between 30 and 90 days to get all of your due diligence done and close on the property. So once you get the property under contract, you're going to obviously rework numbers again. Now that you've got the number, the actual number that the property is under contract for, you're going to underwrite the deal. You're going to start doing your due diligence with contractors to figure out how much your due diligence is going to cost you. And really quickly, you need to start putting together a property packet. Okay, this property packet is something that you're going to send out to investors, okay, that are going to tell them about the deal. So if you've got, let's say it's a 100-unit apartment complex, you're going to put all the numbers in there. Here's what it's currently doing. Here's the pro forma, or what we believe it's going to do. Here's the renovations that are going to take place, how much it's going to cost, what that's going to do to rents, what that's going to do to the net operating income, and what we believe it's going to be worth on the back end. Okay. And so what we're going to do is we're going to estimate what we believe our returns are based on all those calculations that we've made. Okay, so we've got a couple of different returns. We've got, and we've talked about this in previous episodes, but we've got our cash flow. We've got our principal pay down, which we combine with the increase in value of the property. So our just total equity or our total appreciation of the asset. Okay. And those are going to be the returns that we're going to show to the investor. So the investors, we usually create kind of two types of returns. The first one is what we call a preferred return. Okay. And then the second one is basically the overarching or the overall return of the asset. Okay. The preferred return is basically the incentivization of the investor to give us money, which is the preferred return means the investor gets paid first. Okay. So let's say, for example, we offer an 8% preferred return to the investor. What that means is that if we only profit 8% on the deal, the investor side gets all of it. The general partners would make zero in that case. Okay. So it means that we're paying our investors before we pay ourselves. Okay. That's how we incentivize investors to say, look, like if you guys don't make money, we don't make money. Like you're going to make 8% before we make a single dollar. Okay. Again, that preferred return may vary. It may be 6%. It may be 8%. It may be 10%. It may be 0%. Okay. Depending on the project, there may be projects where there's so much money that has to go into the property before any money is even made. It may be a 0% preferred return for a certain period of time. Right. And so that's where general partners have to figure out the best way to market the property and to try to generate those investments. If somebody comes in, for example, or if you get a property where you know it's not going to generate any cash flow, there's a couple ways to go about doing that. Like at least no cash flow initially. There's a couple ways to go about doing that is either A, try to find investors that are okay with no preferred return or no upfront cash flow so that they can get maybe a bigger return on the back end, or as investors, as general partners, you can do a bigger raise. So let's say you only need $1 million. Well, maybe we go raise $1.2 million and we use that $200,000 of extra money to pay back our investors and give a preferred return. Okay. But now all of a sudden we've increased our overall liability. So there's a determination that the general partners have to make to decide like what's our best course of action here to make sure our investors get paid back. Okay. So you're going to have a preferred return, and then you're going to have the overall return. And they're going to either do this they're going to do this as an overall return, or they're going to do it as an internal rate of return, which takes into consideration net present value, which is going to basically, we need to know how long we're holding the property for. Okay. So that's something else that we're going to put into the property packet as well. What is our exit strategy? Is this a quick turn and burn? Is this a 3 to 5 year deal? Is this a 7-year deal? And again, that's something that is generally established up front, but you have to understand that there's flexibility and that the general partners are 100% in control of, right? So if you say it's going to be a 3 to 5 year deal, and maybe the market has turned and we decide, hey, we really need to hold this for an extra year as a limited partner, you don't really get much say in that. Same thing, if you think that they're going to have your money for 5 years and they want to sell in 3, you don't have any say in that as a limited partner. And obviously there's a reason that they're making that decision to go ahead and sell the asset after 3 years is probably because there's a great return there. There's a significant return there. So generally speaking, I always tell people, when you're looking for a deal, when you're looking for a syndication deal, if you can find something that gives you a preferred return somewhere in the 8% range, and you can find something that has an overall return somewhere in the neighborhood of 16 to 22%, that's a pretty good syndication deal. For the most part, working with syndicators, you want to make sure that you have somebody that's experienced, that knows what they're doing, that understands the process, and that has a track record of success. So I always tell, I think it's really important for syndicators to create a property packet that basically under promises and over delivers, right? So if we're saying, hey, we're looking at a 16 to a 22% overall return, really what we hope we get is a 35% return. I can tell you, when you tell somebody you'll get them a 16 to 22% return and you end up getting them 30, when you're doing another deal, do you think they're more apt to give you money? Of course, right? So if you don't do that, if you get if you promise a 16 to 22%, and I shouldn't say promise, but you work out a 16, 22% return through your numbers and you end up getting a 12%, it's going to be hard to go back and ask that person for money again, right? So under promise, over deliver, that's going to be your best bet when you're preparing this. But again, having an exit strategy. What does the exit strategy look like? How long is it going to be? Okay. The last thing I want to cover before I wrap up today's episode is why real estate syndication can be a really good place to put your money and why I consider it to be very safe. So, real estate syndication, I shouldn't even say, I don't even want to relate it to syndication. It's more relating it to commercial real estate, and the way we evaluate commercial real estate, especially on the residential side when we're looking at multi-unit apartment buildings and things like that. Commercial real estate is not valuated the same way that residential real estate is. Residential real estate depends on what your neighbor sells for, right? So if you and your neighbor have the same home and your neighbor sells their property for $500,000, there's a good chance your property is going to sell for $500,000. On the commercial side, let's say you've got 2 coffee shops. and they're both for sale. And one, coffee shop A is generating $2 million $2 million a year in revenue, and coffee shop B is generating $500,000 in revenue. And the net operating incomes are relative to that. So let's say coffee shop A has $500,000 in net operating income, and coffee shop B has $100,000 worth of net operating income. Which property or which business is worth more? Obviously, it's the one that's making more money. And so it has nothing to do with its location. It has really nothing to do with the building that it's in, the quality. It has all to do with the net operating income. And so when we're looking at syndication deals, we don't have to buy and wait. All right. So I have a podcast on, residential real estate. Don't wait to buy real estate and wait. That makes sense over time. But what if you don't have time to wait? What if you don't want to wait? Okay. Well, then you invest in businesses. Then you invest in commercial real estate. You invest in things where you can force appreciation. You don't have to wait for appreciation. You can force it. And it's aptly named forced appreciation. So what forced appreciation is, and this is the whole concept behind multifamily real estate, is that we can force the property to appreciate. And the reason we can do that is because the property itself isn't really what determines the value. It's the business that's run within the piece of property. So in an apartment building, okay, if you can increase the net operating income, you increase the value of the property. So let's put this into perspective. If you have 100 units in a property, okay, and you can raise the rents, okay, by $100 per unit, okay, times 100. Now you're looking at $10,000 a month of extra income. Okay, that $10,000 per month of extra income is going to be $120,000 per year. The way we evaluate that extra income, let's say there's no added expenses on that increase. Maybe upfront there is. Maybe there's renovation costs. So let's say you go in and you do, let's say you go in and you do $5,000 worth of renovation to each unit. Okay, so $5,000 worth of renovation to each unit would be $500,000 worth of renovation. So you would raise that capital, okay, and you would go in and you would renovate each of those units. And if you renovated each of those units and got $100, okay, per unit in increase in rent, okay, I'm going to teach you how that valuation works. Some of us think about that the wrong way. We go, okay, if it goes $100 per month, that's $1,200 per year. It's going to take us more than 4 years just to get our $5,000 back. But that's not the way that it works in multifamily commercial. What the value of our property is based on is on net operating income. So what we've done is we've increased the net operating income by $120,000, okay, which is still less than what we spent of the $500,000. Again, it would take us 4 years to return that. However, commercial real estate is evaluated based on what we call a cap rate, okay, or a capitalization rate. And that capitalization rate is based on the net operating income. Now, depending on your market, your capitalization rate might be anywhere from 5 to 10. Okay. What that number means, it's a percentage, it's a decimal. Okay. And what that number means is that the cap rate for every dollar, okay, that you increase the net operating income by, you divide that by the cap rate. So if your cap rate is 5, okay, you're going to divide $1 by 0.5 or $1 by 0.05%. Okay. So, or 1 by 0.05, and you're going to get a multiple of 20. That multiple of 20 means for every dollar that you increase the net operating income, the value of the property goes up 20-fold. Okay. If your local cap rate is 10, it's the same procedure. So you take $1, divide it by 0.1, and you take then after that. So it goes into it 10 times. So after that, you have a capitalization rate for every dollar that you increase in net operating income per year, you have a $10 increase in value of the property. Okay. So if we were to able to increase rents by $100 per month $10,000 per month. That's $120,000 per year. Okay. And if we're sitting in a market where the cap rate is 5, that is an increase in value of the property of $2.4 million. So would you invest $500,000 to improve the value of the property $2.4 million? Of course, every single day. Okay. That is called forced appreciation. Okay. In order to do that, we need time. So the time that needs to be on our side is we need time for renovations, right? And generally it might be difficult to go in and renovate the properties while somebody's in it. So we need lease turnover. So when those leases turn over, let's call it before, so it's going to take us probably at least a year to renovate the entire building. Okay. Those leases have to turn over. We have to release the property. Okay. And then what we need to do is we need those new rent rates to season. Okay. So we need to have what we call a trailing 12. Okay. It's a T12, which is 12 months worth of data at our new rent rates. Okay. So what we're going to see in our profit and loss is we're going to see all those rents increase. And then after 12 months of holding those, we'll see our new net operating income jump by $1.2 million. Okay. Or I'm sorry, $120,000. Once we have that new net operating income, now all of a sudden the valuation of our property goes up by $2.4 million based on that current cap rate. That's how we force appreciation. So it can happen. It can be done so many different ways. You can create value adds. So you can go into an apartment building that maybe doesn't have washers and dryers, and you can add washers and dryers. That's going to increase it. You could add in-unit washers and dryers, right? That's going to increase your ability to charge more rent. You can add covered parking where somebody maybe pays $40 a month for a covered parking space. You could add garages. You could add storage units. You could add Amazon lockers. There's all these different ways that you can create value add. Some areas actually have the ability to add on more units. So if you go in there and you go take a 200 unit complex and add 10 more units, now you have a 210 unit complex. Okay. And you're adding that net operating income. So that is the goal behind syndication, is to create forced appreciation that allows the asset to grow regardless of really pretty much what the market does. Okay. Now, if the market appreciates with it and the cap rates compress and you go from a 7 cap rate to a 5 cap rate, even better. Now, all of a sudden, the property is worth even more, and vice versa. If cap rate compression, goes up, and all of a sudden now we have a 5 cap rate when we bought the property and a 7 cap rate when we sold it. Okay, now our profits aren't going to be as high as we thought they would be. But even going from a 5 cap rate to a 7 on that $2.4 million example we just talked about, okay, we're really, we're not losing a whole lot there. We go from 2.4 million. If we go from 5 to a 7 cap rate, we go from 2.4 million down to about 2.15 million. So it's still a significant increase over the $500,000 that we spent. Okay. All right. We're going to stop there for today. That is kind of a big general overview of syndication. Our next episode, we're going to go into a few more particulars on it, and then, like I said, we might get into the nitty gritty. See if I can get an SEC attorney on to talk about that, because that's really interesting stuff as well. So, anyway, thank you so much for tuning in today. Again, grab more information. www.blackyetigroup.com has some more. That's our syndication website. So if you have questions about syndication, contact us, and we're happy to talk with you a little bit more about it, and also let you know about any upcoming projects that we have, any ability for you to get involved in the syndication side. So thanks so much for tuning in. Go out, live big.
Thanks for joining us for this episode of the Live Big podcast. For even more real estate and investment resources, go to blackyetigroup.com/resources and download Nick's complete guide to running your own rental properties. Tune back in next week for another episode, and until then, live big.
Live Big does not provide investment, legal, or tax advice, and nothing herein should be construed as being financial, legal, tax, or other advice. Live Big does not represent that any securities or services discussed are suitable for any investor. No investment or other decision should be made solely based on the contents or information found on the website or podcast. When making a decision about your investments, you should seek the advice of a professional financial advisor or qualified expert.